Go live. Well, hello, everyone. Welcome. I'm Dan Turbyville. This is Powerhouse Fence Show, starting 11 minutes late on a great Thursday. And we've been experiencing some things. So,
Life.
life. We'll just leave it at that. So today we're going to talk a little bit more about finances. So we're going to kind of continue a little bit of what we talked about last week. So we'll go a little deeper into some financial terms, principles, things like that. We're going to touch on some of the stuff we talked about last week. And this time we're going to get into like cash basis versus accrual basis accounting. And then at the very end, hopefully we have enough time to just kind of tease a little bit about assets. So that's what you can expect this week. And hopefully it's something beneficial to somebody out there. So as normal, I need to mute my computer so I don't hear myself. The show is presented by Memphis Fence Company, MFC Manufacturing, Simpalo, and we have a few partners listed up here at the top: EasyG Manufacturing, Fence News, and Thornton Fence Consulting Group. We probably said those in reverse order because it started from youngest to oldest, but anyway, there you have it. So welcome to the show, everybody. Thanks for stopping by. It's cool that you're here. And I'm trying to find what I'm supposed to be talking about. All right. So thank you all for listening, for real. I say this every single time, but I really do appreciate all of you that listen. And, I got a phone call actually yesterday and today, and I have to call this guy back tomorrow. And he was listening to the show, and he called Memphis Fence. I point the wrong way. It's so confusing. So he called Memphis Fence, and he's like, "Hey, I want to talk to you. I'm thinking about doing this and this and need to talk to you." And so I told him I'd call him back tomorrow, and we'd spend a little time whenever I had enough time to spend with them. But I appreciate everybody that listens. If you want to hear us talk about something, let me know. If you have any questions about what we talk about, let me know. If you want us to have a guest on the show, let me know. Whatever you want us to do, you just tell me, because we work for you. During 1 hour every Thursday, we're here for you. And any other time you want to call. So, there's that. We used to talk about tools a lot. You remember that?
Yeah.
We used to have like tool time or whatever. Yeah.
Are you doing tool time?
Well, kinda.
Go for it.
So what we're going to do is we're going to talk about yesterday.
Oh, yeah.
Yeah. So we went out and we did a demo of hydraulic excavator, hydrovac. A lot of people call it like potholing, whatever you want to call it. Hydraulic excavator was the thing that we went out and demoed, and it was pretty cool. And I think we're going to try to buy one. It was neat. I'm going to try to show you a picture of it. If you give me just 1 second, I will try to show you that picture, because I'm never prepared enough to do any of this the right way. And I did have one thing prepared, but here you go. There's a picture of a couple of us, a couple of our guys digging a hole with it. You can see the machine in the background. So it is a trailer mounted unit by Vermeer. The local dealership brought it out to us and let us play with it for, I don't know, half a day or something like that. We took some videos and things like that. And Ilaria, I think I sent you the videos so you can pass it along to the editors, and they'll get it turned into something presentable, and we'll publish it, and you can see what we found out. So if you didn't see the video we did like that with the Caterpillar skid steer compact track loader, we basically had the sales folks here with us and gave them a microphone, and I had a microphone, and we talked about the machine and kind of did a walk around, and talked about all the features of it and stuff like that. And so it's going to be a very similar situation that we did with that hydrovac. But yeah, it was a pretty cool machine. What'd you think?
It was fun.
Yeah.
Yeah, I enjoyed it. Like, I didn't think it was actually gonna take that hard.
Oh yeah, it did its job. It
Yeah.
was cool. So yeah, no, it was impressive. It did a lot more than what I thought for sure. So there's your tool time thing that we haven't talked about.
Yeah.
So today, a crazy story. There's a local supplier that imports ornamental fence from China, I guess. Um, I think that's right. So they called us up today and they're like, "Hey, just want to give you a heads up. We got an increase letter from our supplier and the price is going up 45%." Yeah.
I
That's
mean,
pretty crazy.
it's pretty creepy.
That's wild. 45%. So they call us up, say, "Hey, we got a 45% increase. So hopefully you don't have any quotes out there, right? Because now that's what you're going to pay." So the world's going a little bit mad and we're just doing our best to sort our way through it. I guess we could talk about that on a podcast or an episode. We could talk about what we do to try to combat price increases and stuff because we get in these situations where it's going on and it's like, "Oh, wow, this is crazy." But the reality of it is it's fluctuating all the time. And, there's a lot of times where you might bid a job and if it's got, $100,000 worth of material on it and the price increases 10% over the 3 months it takes for you to negotiate and actually get to contract, well, what are you going to do in that situation? Right. So that's a whole nother thing. But yeah, like I said, it's something that we face regularly right now. 45% increase. That's insane. Like, man, I would hate to be the person that signed a contract 3 days ago and then got that phone call and you haven't ordered material yet. And now you're like, oh crap, well, what do I do? So it's weird. We have a comment. Yeah. So that's Karen. Yeah. And 45% is crazy. I agree. It was wild. So but that kind of stuff is going on and we just do the best we can. So we all I think when I was on Craig Eubanks' Fence Guy Friday show a few weeks ago, I told a story about how when we raced, we used to always complain about, man, the track's too dry, the track's too wet, it's too bumpy, it's too smooth, it's too high, it's too low, whatever it was, right? Like we just complained about something. And there was this one time, there's an older guy, he says, "Hey, guess what? Everybody's racing on the same track." And I was like, oh my goodness, that changed my life, right? And so that's probably been like, I don't know, 20 years ago that I heard this stuff. And still I remember we're all racing on the same track. But anyway, let's get on with it here. Let's recap a little bit of what we talked about last week. And this time I brought some show and tell. So if you're listening to this on a podcast, I'm sorry, you're not going to be able to see this, but if you really want to see it, you can go find the video. So first thing, we talked about all of these things last week, right? So I just wanted to show you a sample P&L and kind of walk through where it is and kind of how it's laid out and stuff like that. So this is very simple. This is probably a year-to-date comparison, right? So they're comparing at August 31st, 2020 versus 2021 is why you see two columns on this one. A lot of times when I prepare one, like our internal stuff, I'll put, if I'm going to do this, this comparison across 2 different years, I'm going to put a percentage increase and then probably a dollar increase, right? We talked about the percentages and how I think that's really important last week. But so you would actually, if I ran this report, I'd have 4 columns on there. But you'll see at the top in that light green square says revenue. So $100,000 revenue. I'm going to just go down that left column and not go back and forth between the two. $100,000 revenue, $10,000 cost of goods sold. So 100,000 minus 10,000 leaves 90,000 of gross profit, or margin is a pretty common word that people use. And then you get down and you see operating expenses, so overhead. And on this one, they have rent, salaries, supplies, advertising, taxes, and utilities. So what's interesting and what I don't really understand is that they actually have taxes on here twice, and it's $10,000 in both places. So I'm not real sure about that. But anyway, you get the idea, right? Expenses, and then down at the bottom, They have earnings before tax and then net earnings. So that's kind of your profit goes all the way down there at the bottom, right? So there you go. Now you've seen a sample of what Art's Paint Supplies P&L looks like at August 31, 2020 versus 2021. I just found that somewhere on the internet. So if I just went and searched like sample P&L for contractor or something along those lines, and that was one of them that popped up, and I put the squares on it. All right, so now I kind of broke it down again too, right? So revenue or sales, and we'll talk a little bit about that here in a minute, but basically income from jobs. So you went and did a job, you turned in a bill for $100,000, you have $100,000 revenue. Cost of goods sold, direct cost to produce the thing that you're selling or the service you're providing. I personally think in the fence industry, we're a service provider more than we're a product provider. But we kind of do both, right? So any of the direct costs, material, labor on site, rental equipment, things along those lines are direct cost. And then below we have expenses, aka overhead. So indirect cost required to run your business. So again, rent, insurance, vehicle repairs, depreciation, office staff, things along those lines. And then down below that, we have net income or profit. I wanted to just like leave it at that high level for now, because maybe if you're listening to this, that maybe is enough, right? Um, but yeah, so there's a lot that goes into that, but that's the basic gist of it. So this time I want to take what we learned last week and what we've recapped so far this week, and I want to build on it, and I want to dive just a little bit deeper into there. So I stumbled around, if you listened last week, I stumbled around a few times because of this like cash versus accrual basis accounting that was going on. And so when I say like revenue and you did a job for $100,000, well, yeah, maybe. Maybe that means that you build the job, or maybe that means that you collected the money, depending on how your accounting is. Okay. And so that's the thing that we're going to explain here. Oh man, I thought I was going to get attacked by a wasp whenever I was coming down here. So they're out right now, right? They're like going crazy. And I just saw something out of the corner of my eye, and I thought that it was like a giant wasp coming to eat me. But there was one flying around in the office when I was coming down here, and I was like, "Oh no, don't kill me."
It's her.
Yeah. Yeah, that jugger's tracked me all the way down here. So anyway, sorry. All right. So we're going to start off with cash basis. And this is probably where most people start. At some point, a lot of folks will transition from cash to accrual, but probably start with cash basis. So, in a nutshell, revenue becomes revenue when the cash is in your hand. So, now you can see how it's a little bit hard for me to define revenue as like you did the job. Well, okay, maybe it's because you build the job, maybe it's because you collected the money. Like it depends on how your accounting stuff is set up, right? So, with cash basis, your revenue is recorded, becomes revenue when you receive the money for the job. So it's not because you completed the job, you gave them a bill, you sold the job, you got a contract. It's not any of that stuff. It's because you got money in your hand. Okay. So let's say you do a $50,000 fence job in December and you finish it on December 21st. Well, your customer's out of town, they're doing things with kids, whatever, and you get paid in January. So with cash basis, that income is recorded in January. So it just so happens to be at the end of the year, right? It rolls over from one year to the other. There's a lot of tax implications that go on depending on which year it's in. You might be adding $50,000 of taxable income in December or in January, depending on how your years are going and things like that. So that's a lot of it, right? So if you actually like get real paper cash, if we remember what that is. So in my farm operation, what I would do is people would buy straw and hay and things like that. And so it was a lot of like small transactions. Somebody might give me $40 or somebody might give me $200 or, maybe 500 or something like that. And it would be cash. And so what I would do is I would just like stick it in a box or something somewhere. And then when I needed to deposit it, I would just take, $2, 3, 4, $5,000 of cash to the bank, and I would deposit that at one time. So with my farm, I wasn't really like making invoices for everything like that. I mean, if somebody's buying $20 worth of stuff from me at 8 o'clock on Saturday night, I'm probably not going to stop and take the time to make an invoice, right? Not the proper way to handle things and not the proper way to run your fence business, but that's how I was doing this little thing that I was playing around with on, nights and weekends. And but I would record the income.
We have a great comment that you should look at.
Oh, do we? Okay.
Yeah.
Let's see. Alyssa says under the mattress. Alyssa says under the mattress. Alyssa is my wife. So thanks for tuning in. I appreciate it. Yeah, wherever it is, we don't talk about where it would be stored, right? But it'd be stored somewhere, let's say. And then when I went to the bank, I would record. I would just create an invoice, and I would probably call it cash sales, and I would just deposit, whatever I had or whatever I was gonna deposit. We'll say that. So again, really, cash basis becomes income when you get the cash. Okay. So I'll give you the technical answer, and then you just know what I did. How about that? So you report it when you deposit it, or when you get it. When you get it. Now, expenses become expenses when the cash leaves your hand. So not when you get the bill, but when you pay the bill. So if you get a $50,000 bill in December, and then you pay it in January, so that's going to hit your cost of goods sold or expenses or whatever it is in January, not in December. So remember the tax implications of that, right? There's normally not a penalty if you pay a bill early, and we'll just throw that out there, and we'll just let that be what it is. So that's the reason it's called cash basis, is because it's all based on cash. Makes a lot of sense. People did good with those words. So it's a little bit easier to manage and a little bit easier to keep track of. There's less demand and less need for like accounting staff and things like that. It matches with your bank statements or credit card statements or whatever pretty well. Well, I guess really your bank statement. That's interesting. So if it's cash basis, when is the credit card charge an expense? When you charge it or when you pay the credit card? If Alyssa's answering, maybe or listening still, maybe she can answer that question. But yeah, so it's a little bit easier to match things with your bank statement. We'll leave it at that because I don't know the answer to the other question. And there's a lot of good tools out there in the world that use automation and AI and things like that to help. Now AI is obviously getting into everything, so you can, you can find stuff that works. Now, it doesn't really give you a full picture of your financial health and what you did actually in that period, because the receipts or the expenses or whatever might roll over into the next month or the next quarter or the next year, anything like that. So you don't really see what you did in a given month when you're operating on cash basis. So that's kind of one of the drawbacks of it. Let's see. Alyssa said, I don't know.
She did.
Yeah. She went to accounting school, and so she's the one that I rely on for all of my accounting questions. And here's an answer. I don't remember cost accounting. Well, I don't know the answer either. So if you're curious, I'm sure Google or someone can help you. But anyway, so yeah, it doesn't really give you that great picture of what you did in any given period. Now, I'm going to go off on a little bit of a tangent right here. And I'm just going to complain to the world, because if you've ever done work in progress, that's very obnoxious to me. I don't like doing it. I know it's important. I know you need it. I know that's the only real way that you can get an accurate snapshot of your business on any given day. I understand all of that, but it frustrates me like crazy to have to do work in progress. We'll talk about work in progress another day. But if anybody out there knows what work in progress is, then there you go. There's my fussing about it. So now your profit, we'll say your net income, right? And your cash flow, they probably line up a little bit better if it's cash basis than they will if you're operating on accrual basis. Because, Your P&Ls are based on cash received. So that's a little bit less confusing because when you look at a cash flow statement and then you have a P&L and the two things are not the same thing and trying to like scratch your head and figure out why are these different, that's a whole thing to learn, right? Is all it is. So I would say this. This is what I want you to do. If you're listening to this, I would urge you to just do this thing. I would say stop listening to this right now. Okay. Well, maybe actually just pause it and then come back later so you can get the rest of it, right? You don't have to leave. Just pause it for a minute. And you can go to quickbooks.intuit.com. You can create an account and sign up for Simple Start. It's $37 a month. And you get 50% off your first 3 months. I don't have any codes. I'm not trying to sell you anything. I'm just telling you, you should be tracking it somewhere. And $37 a month is a pretty cheap way to track it. QuickBooks Online will indeed tie directly into your bank accounts. That's how I did it with my farm. So every single time that money went in or out of that farm bank account, which is another point, I would urge you to have an account just for your fence business. But yeah, anytime money went in or out of that farm account, QuickBooks recognized it and it put a transaction in QuickBooks and it's like, hey, what do you want me to do with this money? Right? Does this go to a bill that you've created? Does this go to what expense account does it go into? Where does it go? Right. And it's pretty easy and pretty intuitive the way that they have it set up to. Oh, I just suddenly was like, wait a minute, intuitive into it. Sorry. So it's pretty intuitive the way that they have it set up. It's not that hard, and you can just start, right? Link your bank accounts, link your credit cards, and start classifying everything. You can go right back to January 1st. I think it does 3 months. So you have a few days where when you link your bank account, it's going to go back 3 months and it's going to pull every transaction in there. I believe is correct. Not 100% positive on that one, but you may have to manually enter some stuff. But if you, again, cash basis, right? So all you have to do is pull up your bank account, pull up your QuickBooks, manually enter those transactions and classify them wherever they go and check it out. You're off to the races. You have the start of a proper set of books and financial statements. Super powerful thing to have, and it's not the most complicated thing in the world. Um, and it's like you're not doing the most advanced thing in the world. You're probably not going to do it perfect. I don't care. You're starting and you're trying something, and you should just spend the time and spend the $37 a month and go do it. Okay. Anyway, all right. I'm done with that. So we've gone through cash basis. Nobody has any questions. Larry, you got questions about it?
No.
No?
No.
Okay. All right. So we're done with cash basis, right? So basically, when the cash comes into your account, comes into your possession, you got revenue. When the cash leaves your possession, you got cost of goods sold, expenses, whatever that is. So now let's go down accrual basis. So accrual basis is the opposite ish. So revenue becomes revenue when you create the bill. So if you complete your $50,000 job that we did earlier in December and you bill it in December, then it becomes income in December. And it does not wait until you receive the money. So you do have to pay taxes for that job in December now. So there is that trade off. And that, again, is only the end of the year. Yeah, Alyssa said, not sponsored. That's right. I just think that people should do it. So there's that whole like juggle, right? About when things are taxable and when they're not. And like we play that game every year. So your cost of goods sold, your expenses, all of those things become a expense or cost of goods sold when you receive the bill versus when you pay it, right? So with accrual base, it's when you receive the bill. So you get a bill for $50,000 in material in December, that hits your cost of goods sold in December. Now it's a little bit harder to manage, but it's not hard. I think don't let people scare you with any of this kind of stuff, right? It is there's challenges and there's obstacles and there's things to learn and there's things to overcome and there's all of this stuff. But I mean, we're out here like you're building fence, or you're selling fence, or you're managing fence installations, or you're doing something like that, I promise you, just doing a little bit of accounting is not more difficult than what you're already doing. So you can figure it out. Now, accrual basis is going to give you a more accurate financial picture. So we talked earlier about the whole timing things and stuff like that, right? We kind of touched on that. So if we do this job in December, we get the bill for the material in December, we create the invoice in December, that all flows right through to our P&Ls, our, books, whatever. It all hits all of that in December. Well, that's good because you did the work in December. Now you have the income in December. You have the cost of goods sold in December. You can see how that gives you a little bit better timing when you're looking at how things went in December over the past 6 years, or when the fourth quarter over the past 6 years, right? You can see what you actually did. um Timing's still not perfect, right? Like that job that we thought we were going to finish on December 21st, we didn't. And we didn't finish it until January 4th, and it was a $50,000 job. So now right out of the gate in January, we got $50,000 worth of income. Well, now that's where your work in progress comes into play, right? Because you did a work in progress entry at the end of the year, and you recorded most of or all of that income back into the previous year. And so that's why the work in progress is necessary, right? Because it fixes those timing errors, and you'll accrue your payroll the same way. So you got payroll for the last week of December that you pay in the first week of January. Well, you move it back to December. And so that way it gives you like a clearer picture of what you did in the year, in the month, in the quarter, in the week. Well, we don't really get down that nitty gritty, right? But you could if you want. So yeah, it gives you a more accurate picture, right? Because it puts it in the right time. So now that gives you a little bit better stuff to look at when you're comparing year over year, when you're trying to do planning, when you're trying to project things, when you're trying to budget, when you're doing all of that, you have a little bit better picture. So the downside is you can you can get into this weird situation where you might be profitable on paper, but you have no money in the bank. Okay. So you got to manage cash flow at the same time. You can't just focus everything on profitability and not care about cash flow. You got to watch both of them. So that $50,000 job that you build in December, and the revenue, remember, revenue was recorded in December, although we've not received the money for it yet. Let's say we also spent $35,000 in December in real money doing the job. So we paid people, we bought material, we spent money doing this job. And we've got a $50,000 bill, which is now a receivable, which is an asset that's sitting on our books. But it's really hard to go to the grocery store or your fence supplier or to pay your Comcast bill with a receivable. There's some ways you can do it. You can, finance receivables and whatnot, but there is that trade off, right? So you got to kind of like understand a little bit more about how all these things tie together, and you got to watch multiple things. So you're in that scenario, your P&L shows the income in December, but you haven't got the money, right? So and another thing, so just because there's money in the bank doesn't mean you're profitable. And just because you're profitable doesn't mean there's money in the bank. You got to manage the cash flow. You got to watch the cash flow, and you got to understand where cash is going. Oh man, it's a lot of talking.
Yeah, it's a podcast.
Oh yeah, that's
Yeah,
right. I
it's
forgot.
okay. It's okay. It's okay. It happens. It's
I forgot
Thursday.
what we were doing here.
It's Thursday.
Ah, that's and it's been a crazy week. Yesterday was complete bonkers. I ran around like a headless chicken yesterday. Hey, Hilaria, you think you could do me a favor?
Yes.
You think you could hand me this tea over here? I don't want to just like get up and walk away from the camera. So if you could do that, that would be so helpful. Oh, thank you.
Oh, you're welcome.
All right. So we talked about what is cash basis. We talked about what is accrual basis, and we have a comment. Let's see. Oh, Alyssa's laughing at me. Sorry. So, which one should you use? right? You have never done any accounting. You don't have any of this stuff. You just take a bunch of receipts and bank statements and all of this stuff to your CPA or whatever tax professional at the end of the year, and you say, "Hey, can you help me, please?" Well, you probably want to start off with cash basis. Say, save Ilaria. Ilaria saved me just now. Oh, and I have. Hold on. What's the
I
drinking
just got a
music?
compliment. This one is going on all the channels.
Hmm? You got a compliment
Yeah,
from who?
from you.
What'd I say?
I saved you.
Oh yeah, yeah. And it's gonna live here for all of eternity.
Oh
There you go.
yeah.
All right. So start off with cash basis, right? If you got nothing now, it's pretty easy to get into it. I mean, honestly, you could make an Excel spreadsheet. You could go back through your bank statements and you could say, okay, this money came in, so I guess I did a job. And then this money went out to whoever. And if I spent money there, it probably was material, it probably was utilities, it probably was whatever. And like you could start there making a pretty simple, P&L. And I would say if you don't have $37 a month to spend, then start there, right? Do something. Uh so, which you probably could just do right now too. So, by the time you get to where you need to swap from cash to accrual based accounting, you probably have a CPA, an accountant, some sort of tax professional that's going to say, hey, it's time for you to start thinking about swapping or kind of, steer you along the way. If you do just want to, right out of the gate to go to accrual, then by all means you can. It's there. I don't think there's any restrictions that will not allow you to be accrual. I don't think there's any time where you have to be cash based. I very well might be wrong though. I will say, as normal, I do some research. I did some digging on this thing, and I didn't run into anything that said you had to be cash basis if this is going on. Man, this is going much faster than I thought it would.
That's good.
Yeah, yeah, we're gonna be done in like 10 minutes, if that long. I'm gonna you know what I'm gonna do? I'm gonna just sit here and man, what kind of stories can I tell?
Oh, that's so mean.
All right. So are there rules about what type of accounting you use? Well, in fact, there are. So IRS publication 538 says you can generally use cash basis if your average annual gross receipts for the last 3 years are less than $29 million. All right. And there's IRS publication 538 is much longer than those 8 words that I just said. So there's more to it than that. There are some rules about like C Corps that kind of tie into it and different things like that. But I mean, $29 million, right? So here's the thing that is maybe the one that's going to mean something to people in the fence world is it says something along the lines of if you're a business with inventory as a material income producing factor. Again, that is in IRS publication 538, and it's also listed in other regulations and things like that. But if you're a business with inventory as a material income producing factor, and I'm not an expert on this, right? I studied as I normally do, but I'm not an expert. What I found was basically, uh, if you're stockpiling inventory and you're operating on a cash basis, then you might want to talk to your tax accountant about that. And you might not be following the rules as they're set forth from the IRS. If you're buying job lots, just buying material for the job and you got a little bit left over here and there, I don't think that matters, right? I'm talking people that are buying like a lot of material and have inventory and have it sitting around and that type of stuff. So they're also, like I said, there's a lot of rules about it. I'm not going to get any deeper than that. If you think that you might fall into one of those categories, then you can check it out, talk to your tax people, and try to get to the bottom of it. But there is information available for you there. So that was really the only. There didn't seem to be a ton of rules. I would think that there has to be more. There is more. In fact, I know there is more. And so there's some stuff like if you're publicly traded and like a lot of things like that that I didn't really think applied to our world. And so I didn't even include them in here. But are there rules? Yes, there are. Do the rules apply to most of us? Probably not. The inventory thing I wanted to make sure that I mentioned. And then, if your gross receipts are over $29 million on average for the past 3 years, then you're supposed to be accrual basis. So now I think we said that we're going to talk a little bit about assets. So let's run through that. And I kind of got to this point and I was like, man, we're not going to have very much time left. Right. And so I didn't do a ton to talk about assets. I just kind of like put a little teaser down here. I really didn't think that I would get through the rest of it as quickly as we've gotten through it. So, uh, for any of you who look forward to me talking for a full hour on Thursday, I'm sorry. I'm sorry. So, yeah, an asset is something your business owns that can help you generate income. Okay. So trucks, tools, inventory, cash, accounts receivable, things along those lines. Yes, all of those can help you generate income. Although accounts receivable, that's an interesting one, isn't it?
Yes.
So accounts receivable is money that someone owes you, right? You've created the bill and you're waiting to get paid. That's accounts receivable. So that's interesting that it can help you generate income. I guess it builds your equity. And I guess that would then put you in a better position when you go to the bank, which might allow you to get a loan that you could then use the loan for money to help you generate income. So that's an interesting thing. But anyways, truck, tools, inventory, cash, things like that are all assets. Now, assets generally are depreciated, but you're not like really that's like trucks, tools, equipment, things like that you're going to depreciate. You're not really depreciating your cash in your accounts receivable. So now there are thresholds. Okay. So the threshold is if the thing cost more or less, if it like, for instance, one of the thresholds is $2,500. So if the thing you're buying costs less than $2,500, then you just immediately expense it. If the other threshold is 5,000 and there's rules about which one you're supposed to use and all of that. Again, I didn't think I'd get this far, so I didn't really get into that. I plan to do that later, but just know that there's two different thresholds, and anything above that number, you're supposed to record as an asset and depreciate it. Anything below, you just expense it as a tool, small equipment, like whatever expense account you have that it fits into is where it's going to go. So you can do Section 179 depreciation. There's also bonus depreciation and things like that. So it'll allow you to claim the full depreciation of an asset at once. So if I bought this little hydro excavator thing that we demoed and talked about earlier, if we buy that in 2025, it's 2025, right?
Yes.
Yeah.
Yes.
Okay. So if we buy that in 2025 and we get to the end of the year and we're profitable, then we could do some, depreciation on it under this Section 179 deduction. But you have to have taxable income to reduce. So you can't go and buy a $50,000 piece of equipment and get to the end of the year and have zero income and write off that $50,000 piece of equipment and have a negative $50,000 income and get a tax return. That doesn't work. You have to have taxable income. And so if it's $50,000 and you have $65,000 of income, well, now you can write it down to 15. So there is, kind of some caveats to that, right? Like you can't use these bonus depreciation type things to bring you into negative income. Otherwise, you depreciate it according to IRS tables. There are tables, and it's kind of based on something's expected lifespan, maybe like 3 years, 5 years, 7 years. I think buildings are something like 50 years or 25 or something. That one stretches out there pretty far. So I think there's a lot of confusion, or I think there is confusion in the world about buying things, right? And what you can expense and what you can write off. And so that was one of the things that I I will get to at a later date, right? Like I said, I didn't really prepare and didn't really get that far into it. But just know like depreciation is the thing that you're writing off if you go buy a skid steer. And you can depreciate it all at one time sometimes. But if you then sell it a year later, then you have to reclaim that depreciation as income. So just be aware of that. You know, you write off something for 50 grand this year, you need to sell it next year. Well, now you got $50,000 of income next year. So, like I said, just be aware that it is a kind of a, I don't know, a risk or something like that. You know, whatever word you want to call that. But anyway, we'll get more into the assets and depreciation and things like that maybe next time. But for now, it's pretty much all I have. I'm done.
Good job.
Thank you.
You're welcome.
Oh, look, even though we started late and finished early.
Yeah, look at us.
So good job. Well, everybody, thanks for stopping by. Thanks for listening. And like I said, if you want to hear something, just let us know. Aside from that, we'll see you next time.